Now, generally, investors pay two sets of fees when it comes to their investments. The one pertains to the advice that is required so that the appropriate investment vehicles are utilized, and the other refers to the actual management of the assets. So what is an appropriate fee to pay? That's the question that we'd like to answer tonight. Welcome, gentlemen. Sean, I'll start with you. I mean, how are fees determined in South Africa? What is the method that South African investment managers use to determine the fees they charge?
Well, I mean, from an investment management point of view, I'm going to talk to these guys just now about it. But I think for the moment, let's cover the advice side, because that's where I really start the work. And one of the problems in South Africa at the moment is there is no fixed idea of how this is actually done. We know that traditionally commissions have always been paid, and that's fraught with a lot of problems in terms of how unbiased and conflict-free is the advice that someone's giving, and perhaps is the advice at all, and is it not perhaps a product sell? So I think that's the one side of it, and to strip out and say, well, we've got two areas, broadly speaking, in the advice space. The one is fees and the one is commission. Thankfully, the regulator is looking more favorably towards moving into a fee environment, which is very, very important. The other side to look at, and when people look at advice, especially in financial services, they've generally had pretty poor experiences. And as point of the discussion, to take a look into the backdrop, there are 100,000 there and thereabouts registered representatives here in South Africa with the Financial Services Board. Of that amount, there is approximately 2,500 to 3,000 what we call certified financial planners that are currently practicing within the South African market. So you've got 2.5% to 3% of the advice market out there that, to my mind, is adequately equipped, experienced, and educated to give solid advice to clients. So I think when we look at advice in this context, we should perhaps focus on those people that are the certified financial planner professionals, which is globally recognized.
Kobie, against the backdrop of what's taken place globally, what has been the theme that we've seen over the past few decades in terms of how advice is charged for?
Well, let's bring a human element into this. Your client rocks up at your offices and he says, you know what, I have tried to invest money 30 years ago, 20 years ago, and you know what, I got really bad advice. You know, I put my money into this thing or that thing or this fund or that fund, and you know what, I lost all my money. Or it was in a fraud case, or there was something that happened. And this is often your starting point when you start doing advisory work with clients, because clients are sitting down and they're actually in a point of hurt. They're not in a point where they're trying to explore ideas.
And they're certainly not trusting you.
Absolutely.
After their bad experience.
Absolutely. And then what they're doing is they're saying, well, how much am I going to be paying for this? And they don't actually understand what is the benefit they're going to be receiving for what they're actually going to be getting. So number one, the onus in the industry is actually to teach potential clients what it is that they can potentially get for the services that they rendered, and then to come to a fee structure that potentially could work for both ends. And the other thing, and I think the onus here is on the investment management industry, is in order to make product and understand product to such a degree so that you actually can start aligning with an advice process, because that becomes really important. Just have a look quickly. This is some work that I got from that I did with the CSIS data. Now that's the Association for Investment Managers in South Africa, and it shows you the number of collective investment schemes or unit trusts that are actually listed in South Africa. Just have a look there. At the moment, close to 1,000 unit trusts that are listed, and most of this growth really happened from about 1998. Before it was actually quite a small industry, and hence a much more easier industry to actually regulate than it is actually to regulate today. I mean, does that ring true to you, Sean?
Absolutely, Kobie. And I think the important point there is when we start looking at advice and more specifically fees, it's got to relate back to value. And going back, I think many advisors out there had their proposition as being able to select the right funds. That's become an impossible task right now. So one has to look and say, well, what is the value proposition that I am actually putting forward on that basis? And it's got to come down to what Kobie is saying, I need to pull every aspect of somebody's financial life, so from tax to law, through to estate planning, to retirement planning, through to what their balance sheet looks like, their income and expenses. Try and get a holistic view of all of that, and through that start looking at what is the type of investment strategy using the various vehicles that's right for what that client is trying to achieve on a personal level.
So it's about building wealth that everyone wants. That's an objective everyone wants to achieve, and how you get there is the question mark, and it differs for each person. So basically what you're trying to say is advice has a price that is worth paying if it's the right advisor.
Correct, absolutely, absolutely. And that price could vary from person to person, but the question has to, or the important part is this: A, what is it that I'm going to pay in this advice process and in the ongoing advice, and B, what am I going to get for it?
Roland, I mean, how do you ascertain what the fair price is? Because I mean, you don't know what the going rate is, and whether you should be charged based on the assets that they have or that under management, or you should be charged on the returns that they're going to get. How do you come to that percentage?
I guess the way that the industry normally operates is that you're looking at the peer group. So you want to see if you're in the upper end of that echelon. But there's no real published kind of fee scale other than the underlying funds. I mean, I don't know what fund advisor or financial planner X is charging versus another financial planner. You got to shop around is probably the right way to do that. But maybe I can just ask you about the one of the key aspects of financial advice or planning is risk management, right? In fact, that should probably be priority number one. What tends to happen in the industry is we end up picking managers. And as you say, it's with that kind of selection, it's not an easy game, and it's probably a silly game to play. But how do you look at risk, and how do you advise clients on risk? Because that's about asset allocation. It's about looking at not timing the market risk management, but in terms of looking at the client's kind of profile. But clearly, risk must be right at the top.
Absolutely. I
and
think
that's your value proposition that you should be charging for, rather than I'm going to pick you Alan Gray over Coronation.
Absolutely, without a doubt. I think it's important to say, is it the most important thing in financial planning? No. Is it the most important thing when looking at an investment strategy within the realms of financial planning and advice? Then yes, absolutely. When we're looking at risk management, I think the key word you brought out there really comes down to asset allocation. Okay, so what we do on a very small scale, and if I was just to highlight that section of it, is to say we get to the point, we understand exactly what a client's investment objective is, given what they have available to them now, and given what they've got in terms of disposable income going forward. From there, we can start getting an investment objective in terms of a CPI plus type return fund, and then we start looking out and say, well, how can we match some kind of investment management style to that objective that the client has got? For me to start managing asset allocation and trying to do the rebalancing on myself, that's not where my core focus lies, and I do not have the capability to, on a daily basis, make sure that these things are taking place. So by and large, that needs to be outsourced. And then from a philosophical point of view, each plan is going to turn around and say, well, I want to look at a fund or a strategy that's got strategic asset allocation or tactical asset allocation.
So who should be liable if the fund doesn't return? It doesn't provide returns? Because, I mean, we were just talking about, we've seen how resources have been hard hit this year. Who should be liable? Should the financial planner also have a role to play in that? Or is that, out of the spectrum? Because, basically, how do you quantify that?
I think if the errors come in terms of the planner taking on the incorrect fund manager or type of fund, given their risk profile, given their investment objective, then absolutely it lies with them. If, however, it has been advertised that these are the intentions of the fund and the fund manager, what they're trying to achieve, and as far as it's reasonably possible, they're going to achieve that. We know that guarantees are not going to happen in the equity market. So if they've kept up to what they said in terms of their philosophy and in terms of their style and in terms of their processes, I don't think anyone can start pointing the finger other than to say that is the market as well at some point.
You see, I mean, this is the one end of the equation, which is really talking about advisory work and kind of getting a fee right for advisory work. But on the other end of the equation is kind of the investment management fee. Now, it's interesting to note that when Charles Ellis writes in the Financial Analyst Journal, and it's a guest editorial that he writes in the Financial Analyst Journal, and he asked the question, how much are we paying investment managers? Aren't we not paying them maybe too much money? And he makes the point that in the 1960s, Morgan Bank, which is a front runner of JP Morgan, were the very first folk to actually start paying flat fees or asking flat fees for investment management services.
So
and
not basically geared towards returns, basically?
No, not geared towards returns at all. It was just a flat fee. And at that stage, they were paying close to 0.25% of your total asset sum, and you were charged on a quarterly arrears basis. Now the issue is to today, internationally, many mutual funds charge way in excess of 0.25%. I mean, that's the price of an exchange-traded funds, even though you could find ones that are slightly cheaper. But certainly, if you want a mutual fund, you're going to pay probably in the order of about 2, maybe even 2.5% in some points. Now, I mean, in South Africa, if you look at the mutual fund industry or the unit trust industry, those fees are lower. And,
Where do they stand? What's the average?
well, I would say that you would pay anywhere, for actively managed, active asset allocation funds, anywhere between 1.4 all the way up to, and you can get those funds up at 2.5. You absolutely can. But kind of somewhere in that space, with the sweet spot kind of being at the 160, 170 level, which certainly is cheaper than what you've seen in.
But that's just the management fee, right? That is not the end investor's total cost, right? I mean, you probably got a much better handle on this,
Correct.
but you got to look at the advisor's fee. You got to look at all the what are the other fees? Platform fees.
You've got the platform fees, and of course you've got the trading costs as well, which will ultimately come into the total expense ratio. But the trading costs, not the platform fee. So you do have a number of fees, and I mean, I've sat down.
What does that add up to? If as an end investor.
Well, I mean, what's the most scary number that you've seen in terms of
total?
TERs, basically?
The worst number I've come to date is 5.6%.
Yeah.
Which
Of
is
a
just
TER
ludicrous.
or?
That's a total cost. That's
Total cost.
that was including excluding advisor fees.
Including,
on that one.
including inflation, you're basically at the long-term equity return.
Exactly, and I think the point here is we're talking about what is the current norm, but we can go back 10 years back, even 5 years back, and what we see as a current norm today was not a current norm back then. And so what I'm finding more and more is those individuals with policies essentially are paying fees that are just not warranting what they're getting in terms of value.
So what needs to change? Is the regulation keeping up with this? How is this going to change that people are paying a fair price for the management of their funds and their money?
I think, from a regulator point of view, there's a lot being done from a commission's perspective for advice. And as far as possible, and say ultimately commissions must go, fees must come in. And how you pay for your fees, there's a number of ways you can look at that. In the investment management circles, I think what we're seeing is pure from a competition point of view. They are getting trimmed. And secondly, I think the question of, is active management providing the value that we're looking for, is forcing asset managers to look very, very closely and say we need to trim these numbers as far as possible to remain competitive.
And to lure back people into them, because ETFs and indices have become very popular.
I mean, let's add a little bit of spice to the debate today by actually having a look at kind of long-term fund returns and having a look at how well managers on average have actually done. Look at the graph that we've got on the screen for you. Again, this is numbers from ACISA. This is up to the end of December 2011. They update this on a yearly basis, and what you're seeing is general funds. So these are general equity funds, their returns relative to the all-share index and what you could have got out of the all-share index. And you can see that there's slight underperformance relative to the all-share index over 3 years, over 5 years, those are per annum numbers, and over 7 years also per annum numbers. And if we just fast forward and we just go and have a look at how you've done in style funds, those are our style funds. Remember, equity is what we call value funds or growth funds. And again, relative to the all-share index, you see the blue bars indicate value funds and the red bars indicate growth funds. And then obviously the orange bars continue to talk about or show the FTSE all-share index's returns. Over 3 years, you can see equity, value and growth funds have actually done quite well relative to the all-share index. But over 5 years and over 7 years, well, quite frankly, in some cases, they even lag relative to the all-share index. Roland, I think the one thing, if you're going to be tracking an index, you need to potentially strip out a little bit of a fee relative to that all-share index as well.
Yeah, those are index returns without any fees attached to them. So yes, there are fees. They should be at the lowest end of the market. Index tracking funds don't deserve certainly a performance-based fee or anything else. I would think that on the retail space, you're looking at about 20 to 30 basis points, going up to sort of the more exotic index tracking funds, 60, 70 basis points. And then there are the offshore funds as well, which go up to 100 basis points.
Okay, so Sean, you're an investor, you've got some money that you want to put into a fund, you're choosing to go with an active manager. What are the questions you need to ask, and what are the big red flags that will make you go move away into another fund?
Do I have to go active here?
Well, okay,
let me give you an idea of where active plays a role, because I think for too long we've had the argument of active versus passive.
Yeah.
What the debate should really be about is to say when is active valuable and when is passive valuable, and how do you get the best of both in your investment portfolio. So as far as possible, what I do is the core of someone's portfolio is absolutely using and taking advantage of what index tracking has to offer. When I then look at a complementary style to add to that passive, I'm going to look deep value, okay, and with that as well, potentially a little bit contrarian. And as far as possible, I need a manager that is going to have the conviction and is not going to be cognizant of a benchmark, that's what I'm going to bring in to complement.
And when you're talking about fees, I mean, what are the key areas that you need to take a look at when you are choosing those active managers?
Look, fees absolutely come into it, and we have to be cognizant. And like I said before, there's a couple of different layers. So, if I look at specifically one of the management companies that I deal with, they charge a fee of 2%. However, their trading costs are 10 basis points. By the same token as well, certain strategies are wrapped in endowments where they've got a lot of tax savings specific to those funds, so outside of the ordinary endowment type scenario. So through the trading costs and through the tax savings, we could probably bring that down to an effective rate of 1%. So that to me is a meaningful figure.
You see, I think asset management for me is at a crossroads. And it's not just a South African crossroads, but I think it's a global crossroads. You're going to have to make up your mind as an asset manager. Are you going to go the big product route? That means you're going to have lots of mutual funds and you're going to literally look at mass distribution across the board. Then you're going to have to play a fee game at the end of the day. You're going to have to start reducing fees so you can become much more competitive and you can start providing value at a reasonable price. Because as the exchange traded fund market becomes cheaper and cheaper and cheaper, you're going to be forced in order to do so. You're either in that space or you're in the specialist space. If you're in the specialist space, you're prepared to build portfolios, you're prepared to run much smaller mandates, and potentially there, because it's a different service offering, you could potentially warrant to pay slightly higher fees for those. But there's a caveat, obviously. You need to obviously create the returns in the specialist space rather than in the generalist space. And you'll probably find that globally you're going to find asset managers kind of going into those two streams, both for different reasons, but both in order to actually become a little bit more competitive what the industry actually is today.
Yep. So basically what we're saying is that if you're a specialized fund manager and you are choosing to be able to charge high prices, to be able to hopefully deliver those high returns, then you can prop up those prices. But then, of course, the onus is on you to deliver the money, basically, at the end of the day. And what happens when you're not? Should you forfeit returns? Should you forfeit the fees?
Well, go and have a look quickly again at those equity general funds and the graph on your screen. And you can see how difficult it is for managers on general to actually achieve returns beyond a total benchmark such as the FTSE All-Share Index. Now, we could make that the shareholder weighted index. We could make it an absolute benchmark. We could use different derivatives of this. But at the end of the day, managers actually battle on average in order to do well relative to the benchmark. Now, I'm making a very general statement at this stage because I think there are managers which stand out from the crowd, and there are certain managers that do very, very well. I think a global fund manager once pointed out. He said, "Nobody beats the market except for those who we know beat the market."
Yeah.
And that's the point. Can you find them though?
Okay, very quickly, do you think that if you aren't delivering return, if the fund is losing money, that you should forfeit the fees?
As an investment manager?
And asset managers.
It's a difficult question. I'm not an asset manager.
Yeah.
I'd love to say yes, absolutely, it's the best interest of my client, but I don't think they're going to do it.
Yeah.
Absolutely not.
Well, there we go. Let's take a quick break. When we come back, we'll be reviewing the Ned Group Investments Excess Core Diversified Fund. We'll see you in 2 minutes.